if you already have an economy that is stable, aggregate payrolls are fine, everything is okay, PMIs are pointed up, we have all of the AI action plan and the stimulus that's going to come from the capex of the AI situation. I think the people that are investing and going through it are focused on one thing, which is, I guess the economy is somewhat sluggish from a payroll perspective. Is that related to AI? But one thing is certain, we just came out of a banger of earnings despite all that going on, and it looks better going forward.
Visser starts by addressing the elephant in the room. Everyone wants to know what the Fed will do next. Will they cut 3 times this year? 4 times? More? Less? But he insists this debate misses the bigger picture. Rate moves shouldn't be a surprise anymore. We've seen the playbook before. What matters is how markets are behaving. And right now, markets are acting as if we're coming out of a recession, not heading into one.
Everyone's focusing on how many are the Fed going to do this year, what's going to end up happening. And I think everyone needs to take a step back because this should not be a surprise to anyone. We've talked about it. I think the tariffs have obviously had an impact on some of the manufacturing side jobs in terms of the uncertainty that had gone on. With the reciprocal tariffs only really happening in August and everyone kind of waiting to see how this would play out, what the demand side would be as some of the price pass-throughs were going. We're kind of in a point where on a small term basis, I want to say to everyone, the market's acting like we're coming out of a recession, not going into one. And I say that because as I read through the X post in the minutes after, all of them were pretty negative going in. Most banks said, well, if this number comes in 0 to 25,000, the market's going to be down 50 to 100 basis points. So I think there's a bias still from people to either believe inflation is bad or believe if it's not inflation, oh, we're going to have a recession if jobs are bad. And there's a middle ground here, which I think, again, people just have to accept. The tariffs did put a hold on things and they've kind of freaked people out a little bit. The AI action plan is in place. The building and the whole situation is going to start to go. We saw PMIs go up in the month of August around the globe, not just in the US. The ISM PMI, which came out this week, was only slightly higher than it was and came in a little bit lower than where people forecast. But I think what people have to start realizing, if you look at the market, the housing market's doing well. Why is the house in terms of the stocks? The reason the housing stocks are doing well is because they're starting to build in that rates are going to get lower. And so if you already have an economy that is stable, aggregate payrolls are fine, everything is okay, PMIs are pointed up, we have all of the AI action plan and the stimulus that's going to come from the capex of the AI situation. I think the people that are investing and going through it are focused on one thing, which is, I guess the economy is somewhat sluggish from a payroll perspective. Is that related to AI? But one thing is certain, we just came out of a banger of earnings despite all that going on, and it looks better going forward. Everyone watching this on a week-to-week basis, I think the thing we do better than any regular program that I see is we kind of stay inside the fairway with what's happening. Jobless claims have not budged. They're up slightly. That means we're not seeing job losses. We are absolutely not seeing hiring. So this is a reflection, and we talked about it last week with the study on the realities of AI. And I just want to remind people, when you read people saying a recession is coming, the last cyclical recession, and that means I'm throwing out COVID, but the last time we had jobs were weakening and then we got a recession, that was pre-iPhone. I don't know how to describe to people, you're talking about history that seems reasonably, short time ago. The first baby boomer had not retired. These are dramatic shifts in the technology side. We were doing QE back then. We were coming out of a housing bubble. Now we have a problem in the housing market. Not that it's collapsing, as people want to say. People can't sell their home because they have a mortgage of 3%. And if they sell their home and have to go buy a new one, it costs too much. The housing affordability is a problem because we're not building enough supply. This is a very unique situation that you can't go back in history and compare it to. There's a distribution of wealth problem that has been created by the smartphone, the AI, and all of the printing that's going on. When you increase your transfer payments dramatically to two groups. One is, okay, people are retired. That means they're finally getting Social Security. Well, they also have a pension, a lot of them. And if they have that, they have money to spend, and you move the rates up, which means they're getting money from the government in their bank account. For the people on the poorer end and the lower end of the economy, they're getting more transfer payments. These increased dramatically post-COVID. So we just have, an economy that I hate to tell people, it's kind of boring. It's not as dramatic as people want to make. We've had nominal GDP above 4.5% for 5 years straight, but the amount of recession fears and the amount of times that people get off worried about things, we're just in a situation where everyone who's involved in the crypto world. So if you separated your audience by people that knew me from the macro world and people that have grown up with you on the crypto world, debasement is the major story. They have to run the economy hot, and rates need to be lower than where inflation is going to be. And that's where we're headed. So instead of trying to fight it, I'll use Darius Dale's comment that he said to you, focus on the destination. The Fed's going to be more dovish going forward. They're going to be running the economy hot. Make your investments based on that.
For the past decade, U.S. megacap tech, the Mag 7, dominated. But with valuations stretched and returns concentrated, Visser believes capital will eventually rotate into new areas of the digital economy. And here, Bitcoin stands out. Bitcoin, he says, should be viewed as a risk asset tied to the digital economy. When the Mag 7 no longer carry the market, the trillions parked there could begin migrating into assets like Bitcoin.
If people go back and they go watch those and they looked at what we talked about, one of the things that I said repeatedly is I highlighted the market cap of the stock market relative to GDP and the fact that it was over 200%. And my argument for why you should be looking to buy stocks in the panic is they can't let it sit down here because they've financialized the economy. And unfortunately, whether people like it or not, this gets into the fourth turning. This gets into everything that the crypto people all know really well. But the macro community is still looking at, oh, we have to go through the Great Depression to get out of this. When the reality is, no, we're not going to do that. So once the printing press became a thing after the Great Financial Crisis, prolonged bear markets are not allowed. You can have a fall of 20%, and we've had plenty of them over the last
Had one this year?
Yeah, we had one this year. We had one in 2022. We had one in 2020. They happen all the time. 3 and 5 years is a lot of corrections to cleanse the system. But people still believe, academic people still go back and they look at history and say this always ends badly. This is not a great time for the median voter in the country, which is why we're seeing protests around the globe. It's why we're seeing protests here. It's why crime is needing. You have a situation that all of the revolution things that people think have to happen, they are happening. But a prolonged bear market cannot happen because that is an issue that they can't allow to happen. They've allowed the market cap to get bigger, too big relative to GDP. I traded regularly from 1984 is the first book that I got, all the way until 2013 in terms of sitting in front of a screen every day and trading. Guess what? When you're trading, you're wrong all the time, meaning at least 50% of the time around there, you're wrong. So I've been wrong. I will be wrong. In this case, since it's up for the year and I bought some when it was down during liberation time, I'm enjoying the fact that it's up, but it hasn't done well. And I wrote the paper because I was on I was having a conversation with Sam Callahan, who I'm sure you've met, and he and I had never met before, but I've liked his research pieces that he's done with Lynn Alden, and I thought they were very, very good. So we were having a conversation, and at the very end, he just made a statement when we were talking about why it hasn't gone up. I gave my thoughts, which I'll give you, and I wrote in the article, but he made the statement that, yeah, I still think people view it as a risk asset. And when he said it, it hit me that why do people think being a risk asset is bad? The only thing you make money on in your lifetime are risk assets. That's the whole point of it. The point of the article was risk assets come and risk assets go. There are plenty of things like emerging markets are a risk asset, but if you've invested them for the last decade, you haven't made any money. China is a risk asset. It's 10-year consolidation. The only things in the U.S. stock market that have worked have been the Mag 7. So the point of the article was really twofold. One is when you say it's a risk asset, yes, it has the highest correlation based on the work that Lynn and Sam did to global liquidity. Great. But it also is a risk asset in the fact that the way that I think about it, and the reason I said when the Mag 7 is no longer an easy investment for people, that total $15 trillion market cap is going to start to switch into something that is related to the digital economy, which those names are, and Bitcoin, which is, it's a risk asset that's connected to the digital economy in some way, regardless of what people think. And so the point was, if the Mag 7 are no longer deemed a risk asset, meaning they're not outperforming the market, then that's when I think things like Bitcoin will start to find their thing. I will end with one thing here. I do believe that I've said this repeatedly, and I've talked now to enough people. I think you and I have talked about it as well. There's a lot of people from 2022, investors or entrepreneurs, who went through a lot of trouble with the government in terms of regulations, and they lost a lot of money in terms of the rise and then the collapse. And even though Bitcoin has gone higher, the rest of the system, if you strip out Bitcoin and Ethereum, it's not good. So I think every time that there's anything, I think there's a rotation that happens. So anyone that has money in Bitcoin, I think it's been a funding thing. I saw this with the .com bubble. I really do believe there's an overhang of people within inside the industry that are entrepreneurs, that are innovators, that need to sell to finance other things. I think we're working through that. I still believe there's going to be a violent short squeeze at some point. I've been wrong on that as well, because obviously we've sat here, but I do believe we're going to go higher, because now that the Fed is cutting, and now that we're officially in the game of earnings are good, the economy is going to get better because of all the things that are happening with inside the AI action plan, and the Fed is going to be dovish going forward. I can't think of a better situation.
That said, Visser doesn't dismiss the challenges facing crypto. Many entrepreneurs and investors from the 2021 to 2022 cycle suffered heavy losses, regulatory pressures, and liquidity crunches. Outside of Bitcoin and Ethereum, most of the ecosystem remains weak. Visser's message is clear. The economy may look boring on the surface, but beneath that calm is a powerful transformation. AI investment, liquidity cycles, and policy shifts are reshaping the playing field. And for investors willing to embrace risk assets, the destination is much brighter than the headlines suggest.